Hello. Hi everyone. A very good evening to all of you present here. I'm Nitisha Jain, tax expert associated with Clear, and my area of expertise is income tax. I'm extremely very sorry for the delay as there was some technical issue with this thing. So now we'll begin our session without any further delay. Thank you all for joining such a great number. I'll make sure that we'll be making the session very interactive one. If you have any queries during the session, you can just post down in the chat box. My colleague Namita is there to answer all your questions over there. And once I'm done with the presentation part, I'll also be taking a few questions at the end. So, coming on to our today's agenda, first of all, we'll be discussing about new versus old tax regime, how you can decide that which regime is will be best for you, what are you suitable for, and like that. Then, how you can increase your take-home salary by maximizing your taxes, by maximizing your ATC investments and everything. Then, apart from ATC, there are other tax saving avenues also. We'll be discussing that. Then, what are the NPS? What is NPS? What are its benefits? We'll be giving a brief about that. Then, there are some common mistakes which normally a person do while investing. So, we'll be throwing some light on that. And at last, I'll show you the demo of ITR of filing via Cleartax, and this will be followed up by Q&A session. So, coming on to our first topic, which is understanding new versus old tax regime. So, this is the second year in which you have the option. You have the option to switch between these schemes, and from last year onwards, we all were having this that we can choose either old regime or new regime. This was very long demanded by most of the taxpayers, but it came with the catch of removal of all the deductions and exemptions that were available under the old tax regime. But last year we saw that many people are still not having clarity about the new regime, when to use it, who all can opt for this, what will be its benefits, and everything. So now we'll be discussing all these topics over here. Last year's budget has introduced a new taxation regime which an individual taxpayer can opt for, of the lower tax rates coupled with very few deductions available and fewer exemptions allowable, instead of the regular tax regime where you have to pay tax at higher rates but you have right to claim all the exemptions and deductions. Salaried people have right to choose between the old and new regime, but the person who is having the business income do not have any right to switch back to the old regime if he or she has opted for the new regime for this particular year. So the person who is having a business income have to make this choice very wisely between switching the regimes, taking into account the long term tax implications. Say, for example, you are a salaried individual, you have only salary income, and you have chosen new regime for this particular year. Then from next year onwards, you thought that you are having various kind of deductions and exemptions which you want to claim, and you want to switch back to the old regime. Then in that case, you can do, as you are having only the salary income. So the person who is having salary income have the right to switch between both the regimes every year. But say, for example, you are having salary income, along with that you are also having the business income, and if you have chosen new regime for this financial year, then from next year onwards you'll not be having any right to switch back to the old regime since you are having the business income. So this is what I was trying to explain, that the person who is having the business income cannot switch back to the regime, the earlier regime which they have opted for. So you have to make the choice very wisely. The new tax regime has lower income tax rates for income up to 15 lakh. But what needs to be focused upon is that lower tax rates are available only if the taxpayer is willing to give up the exemptions and deductions which are available. So salaried people are granted this option to choose between the regimes at the time of making their tax declarations, and even if you want, like say for example, you have told your employer that you will be following the this financial year you will be going with the old taxation regime, but when you will be filing your income tax return, you found out that you are getting more taxation benefit in the new tax regime. Then also at that time you can switch to new regime, at the time of return filing also. So as you can see, this is the comparison table of the new regime and the old regime. Income from 2.5 to 5 lakh is taxed at 5% in the both regimes. Now, income between 5 to 7.5 lakh would be taxed at 10%, while income between 7.5 to 10 lakh would be taxed at 15%. This was 20% flat on the entire range for the existing regime. Earlier, rupees 10 lakh plus slab rate was taxed at 30%, which now has been broken into three parts: 20% for 10 to 12.5 lakh, 25% for 12.5 to 15 lakh, and then 30% for 15 lakh and above. The current system is complicated to say the least. So, looking at this new slab rates, a thing which comes into everybody's mind is that this is giving us the lower tax rates. So, this regime would be beneficial. This should not be a criteria for selecting which regime you should go with. There is one common question that which regime will be beneficial for me. But unfortunately, there is no single answer to this. But although looking at the reduction in the tax rates, new system looks better. But while figuring it out whether to choose between the new versus old regime, it might look complicated. So, but if you approach it in a systematic way, it is not that difficult to figure this out. Here is what you need to do. First of all, you'll have to calculate all the exemptions that you are availing. If you are living on rent, then you would be claiming HRA, right? And HRA is the biggest salary exemption which a salaried individual avails. So apart from that, the other tax-free components include LTA, food bill, phone bills, etc. All these will become taxable if you choose to shift to the new tax regime. Then secondly, you'll have to look at the deductions that you can claim. So as a salaried employee, two deductions that you automatically get are standard deduction of 50,000 rupees and your contribution towards your employee provident fund. In the new regime, you won't be able to claim these deductions even though you'll continue to contribute to EPF. Over and above, you cannot claim deductions against your home loan if you have one, or insurance policies, which till now has helped to reduce your taxable income to great extent. Now just combine these exemptions and deductions and minus them from your salary to see what is your taxable income and what it would be if you let go all of these deductions and exemptions. So this should be a deciding factor that which regime you should go with. There is one Cleartax calculator. Namita will provide the link in the chat box. When you will click on this link, you will see this kind of page on your screen. First of all, you'll have to select your age, 0 to 60, 60 to 80, and 80 and above. When you will go on to next step, you'll have to enter the income details like income from salary, if you are having any kind of house property income, if you have received any income from other sources like from interest and everything, that you'll have to enter. After that, then in third point, you'll have to enter the deductions. Like if you have any kind of ATC deduction, ATD, like with some chapter 6A deduction it will ask, and you'll have to enter the amount. Then in fourth point, you'll see a summary table in front of your screen, and it will be your comparison table between the old tax regime and the new tax regime. In old regime, how much tax you are liable to pay, and in new regime, how much tax you are liable to pay. So by using this calculator, this will be very easy for you to make your mind or decide very wisely that which regime is beneficial for you, how much tax you can save in the particular regime. As per your income, as per your deductions or exemptions, whichever you are claiming, you can make this choice very wisely. Then coming on to, I'll explain you this by one example also. Miss Y is an employee who earns 8 lakh a year. Being salaried, she was contributing towards EPF and she was also having the HRA. Apart from that, she also claimed LTA amounting to 25,000 rupees. Now let's see which tax regime is beneficial for her. So 8 lakh was her gross total income. We entered that. Then from old regime, we can avail standard deduction, EPF contribution, HRA and LTA. But these all exemptions are not available under the new regime. So we have not entered anything in the new tax regime column. So net taxable income under old was 6,70,000 and in the new tax regime it was 8 lakh rupees. Now coming on to the taxation slab rates. Her total taxes, which was coming in the old regime, was 46,500, and in new regime it was 45,000. So it was clearly evident that apart from having some deductions and exemptions also, she was getting more benefit in the new taxation regime. So you cannot make this decision like if I'm having exemptions and deductions, I should go with old, or if I'm not having any kind of deductions, I should go with new. First you'll have to calculate it yourself and then you have to proceed. By using the calculator, your calculations will be very easy for you. Now coming on to our next topic about the what are the smart tax declarations which can increase your take home salary. First and very popular exemption, which is HRA, house rent allowance. So it is the component of the salary which is received towards the rent payment and is allowed as deduction from the taxable salary. Some people are having this doubt that whatever rent amount I am paying, I can claim it entirely as my HRA exemption. This is not the case. Income tax laws have provided three basic conditions to claim the HRA exemption. First one, actual HRA which is received by the employee. Second, 40% of the salary for non-metro city, or 50% of the salary if the rented property is situated in metro cities like Mumbai, Delhi, Kolkata and Chennai. And the third condition is actual rent paid less 10% of the salary. Whatever will be the least amount from all of these three conditions will be allowed as your HRA exemption. And some people will also be having this question that what if I'm having a loan as well as I'm paying rent? So can I still claim HRA? Answer to this question is yes, you can claim the benefit of HRA if you own a house and are claiming deduction of the principal repayment under section 80C and the interest component under section 24. But say for example, you have a house property in Mumbai which is let out, and you live in a different house in Mumbai itself and pay rent for that. Then in this situation, can you claim HRA? No, you cannot claim HRA if you are living in a different house in the same city and you have a self-occupied house in the same city itself. If you are having your own house in different city and you're living on rent in a different city, then in that situation only you can claim the HRA benefit as well as your home loan benefit. Now, are you also unsure about how to claim HRA if you live with your parents? Those who live with their parents can pay rent to their parents and save tax on HRA. How to claim HRA by paying rent to your parents? This would be the question which would be coming in your mind. So for that, in that situation, you can pay rent to your parents if you are staying with them. For that, you should be transferring money, the rent amount, to their bank account or pay them via check. This way, you will be able to claim your HRA deduction properly. Since rent is paid to the owners, property must be owned by your parents. It may be owned by one or both of your parents. So you can deposit the money to any one of the parents in case of joint house ownership, or to the parent who is the legal owner of the house. Remember that you cannot be the owner or co-owner of the property, since you cannot claim tax exemption on rent paid to yourself. Some documents which would be required to claim the HRA while staying with your parents would be the rent agreement and rent receipts. Usually, employer asks for the copy of rental agreement for their records. So you can submit the agreement or rental receipts to them so that they can properly calculate your HRA exemption, and they'll be including the HRA exemption amount in your form 16 which you'll be receiving now. But if you forgot to submit your rent receipts or HRA details to your employer, then also if you have paid the rent genuinely, then you can claim the HRA exemption amount at the time of filing your ITR also. You can include that amount in your return. And if you want to calculate your HRA exemption yourself, then for that also there is one HRA calculator of Cleartax. On Google, you'll be getting this link very easily. You can open that link, you can enter the details which they are asking, and automatically you'll by using that calculator you'll be getting your HRA exemption amount. Now, second thing, the interest paid on home loan. So if you are having a home loan and so buying our own house is dream for everyone, right? So that is why department has provided various kind of tax exemptions and taxation benefits for this purpose. In this situation, home loan must be taken for the purchase or construction of a house, and the construction of house must be completed within 5 years from the end of financial year in which the loan was taken. If you are paying the EMI for the housing loan, it will have two components. First one will be the interest component, and second one will be the principal repayment. Interest component will be coming under the income from house property head under section 24, and you are allowed to claim deduction up to rupees 2 lakh in the interest part under section 24, and the principal repayment component will fall under section 80C up to the limit of 1.5 lakh. So you'll by taking a home loan, you'll get a document, right, from the bank, and in which the interest component and the principal component would be separately mentioned. So that interest part will be coming under income from house property head, and the principal part will be coming under ATC deductions. Limit is 1.5 lakh. So if you are also having, there is also one deduction in respect of interest paid towards the home loan during pre-construction period. Say, for example, you bought an under construction property and you have not moved in yet, but you are paying the rent, but you are paying the EMIs. Sorry. So, in this case, your eligibility to claim the interest on the home loan as deduction begins upon the completion of the construction or immediately if you buy a fully constructed property. So, does this mean you would not enjoy any tax benefits on the interest paid during the period falling between borrowing of loan and the completion of construction? No. Let's understand this why. The income tax law provides for the claim of such interest also, which is called as pre-construction interest, as a deduction in 5 equal installments, starting from the year in which the property is acquired or the construction is completed. Over and above the deductions, you are otherwise eligible to claim from your house property income. But again, the maximum eligibility remains capped at 2 lakh rupees. Now there are various Chapter 6A deductions. Under this, ATC, ATD, all the Section 80 deductions are included under this Chapter 6A list. Now we'll be discussing all of these one by one. So our first and very foremost favorite section is ATC. Being the most famous, there are other deductions which are beneficial to the taxpayers to reduce their tax liability. Now let us understand all of these in detail. Talking about ATC, first deduction which most of the salaried people avail is the employee provident fund. Employer gets deduction for the amount contributed towards EPF of the employees as business expenditure. There is no tax liability for the employee in respect of the contribution made by the employer. Up to 12% of the basic salary beyond it will become taxable in the hands of employee. Likewise, in case if the aggregate amount of the contribution made by the employer towards employees EPF superannuation or the NPS account of the employee taken together, if it exceeds 7.5 lakh, then such excess amount becomes taxable in the hands of the employee. Then children tuition fees. The tuition fees which is paid for the education of two children is eligible for tax deduction under section 80C. Fees can be paid to any school, college, university, or any kind of educational institution which is situated in India. Fees have to be for full-time courses only. Then if you have taken any kind of life insurance policy, then the annual premium paid for that life insurance in the name of the taxpayer or the taxpayer's wife and children is an eligible tax saving payment under section 80C. Deduction is valid only if the premium is less than 10% of the sum assured. And as I said in the earlier slide, the repayment of the principal of loan taken to buy or construct a residential property will be eligible for tax deduction under section 80C. And this deduction is also applicable on stamp duty, registration charges, and the transfer expenses. And if you have also ELSS mutual funds, or if you have any kind of tax saving FDs, Sukanya Samriddhi Yojana, if you have made the investment into all of these, These all will be forming part of ATC deduction, but all the whatever amount you invest, but the maximum deduction which you are going to get will be limited up to rupees 1,50,000 rupees only. Now coming on to our next deduction. So ATCCD 2, which talks about the employer's contribution towards NPS. If your employer is contributing an NPS on your behalf, then ATCCD2 will come into picture, and under this section, maximum up to 10% of your salary, you can claim it as your deduction. There is no monetary ceiling on this, that this much amount only you can claim as a deduction, but it is limited up to 10% of your salary income. And if you yourself are contributing towards NPS, then ATCCD 1B section plays a very important part. Now let's discuss this thing in some detail. Talking about NPS, so if you are also concerned about your retirement and are looking forward to plan with tax saving benefits, then NPS is the best tax saving instrument. NPS is known for its investor friendly features, then low cost structure and flexibility. Here you can invest minimum amount of 6,000 rupees in installments or at least 500 or as lump sum. So being the investor, you get to decide how to allocate your money for investments in corporate bonds, equity and etc. Under this section, you can claim additional self contribution up to 50,000 rupees under section 80 CCD 1B. So therefore, it allows a tax reduction up to rupees 2 lakh in total. From ATC, you can claim 1,50,000 rupees, and from ATCCD 1B, you can claim additionally 50,000 rupees. So this 50,000 is over and above the limit of 1.5 lakh. So altogether, from these two sections, you can claim 2 lakh rupees. As a pension scheme, it is important for you to continue investing until the age of 60. But you have been investing for at least 3 years, then you may withdraw up to 25% for certain purpose like your children's wedding or higher studies or building or buying a house or any kind of medical treatment for yourself or your family or etc. You can make a withdrawal up to 3 times with a gap of 5 years in the entire tenure. There are two primary accounts under NPS, Tier 1 and Tier 2. Former is the default account and Tier 2 account is voluntary. Withdrawal from Tier 1 account is not permitted, but from Tier 2 it is permitted. As I said, tax exemption, you can claim from two section altogether, reduction up to 2 lakh rupees, 1.5 lakh from ATC and additionally 50,000 rupees from ATCCD 1B. But in Tier 2 account, 1.5 lakh for government employees and for other employees there is no deduction. Minimum NPS contribution which is required under Tier 1 account is 500 rupees or 1000 per annum, and in Tier 2 it is 250 rupees. But the good thing is that in Tier 1 and Tier 2 there is no maximum NPS contribution limit. Whatever amount you want to contribute, you can contribute as much as you want. Now talking about the other tax saving avenues which are apart from ATC deduction. First one is the ATD. If you have taken any kind of medical insurance policy for yourself or your spouse or your children and your age is below 60 years, then you are eligible to claim maximum deduction up to rupees 25,000. If you have taken medical insurance policy for your parents who are senior citizen whose age is above 60 years, then in that case the deduction amount will get increased to 50,000 rupees. But say for example you have not taken any kind of medical insurance policy for your senior citizen parents, but if you are incurring medical expenditure for them and you are paying the amount for your uninsured parents, then in that situation also you are allowed to claim deduction up to rupees 50,000. But you have to remember that you should not be having any medical insurance policy for them. Then only you can claim the medical expenditure, otherwise not. So ADDD talks about the medical treatment for the handicap dependent. If you are incurring the expenditure and disability is 40% or more but less than 80%, then you are allowed to claim flat deduction of 75,000 rupees. But if the disability is 80% or more, then you are allowed to claim flat deduction up to rupees 1,25,000. 80 talks about the medical expenditure on yourself or for your dependents for the disease which are specified under this section. Some disease particularly are specified are mentioned under 80 section. If you are falling under any of those disease, then you will be allowing to claim this deduction benefit. So under this, if your age is below 60 years, then you can claim 40,000 rupees or the actual amount paid, whichever is lower as your deduction. But if your age is more than 60 years, then you are allowed to claim deduction up to 1 lakh rupees or the actual amount paid, whichever is lower. And if you yourself are suffering from any kind of physical disability, then in that situation, physical disability including blindness or mental retardation, you are allowed to claim flat deduction of 75,000 rupees. But in case of severe disability, which means severe disability 80% or more, then you are allowed to claim flat deduction up to 1,25,000. Then 80E talks about the interest on educational loan. So if you are having, so if you have taken an educational loan, which helps you not only to finance your foreign studies, but also it will help you to save you a lot of taxes. If you have taken that and you are repaying the same, then the interest paid on that loan is allowed as deduction from the total income under section 80E. But the deduction is provided only for the interest part of the EMI, and there is no taxation benefit for the principal part of the EMI. As I said earlier, that when you will get on taking a loan, any loan, we get a certificate from bank in which the interest portion and the principal portion is clearly mentioned. So under this educational loan component thing, you are allowed to claim only the interest part of the EMI, and there is no benefit for the principal part of the EMI. But also a good thing about this section is that there is no limit on maximum amount that is allowed as deduction. You can claim whatever amount, you can claim the entire interest amount which you are paying. It is available for 8 years, starting from the year in which you start repaying the loan or until the interest is fully repaid, whichever is earlier. It should also be noted that if your loan tenure exceeds 8 years, then you cannot claim a deduction of interest paid beyond 8 years. So it is always advisable that educational loan should be paid within a period of 8 years so that you can claim the entire taxation benefits. These are all majorly these chapter 6A deduction. But apart from these, if you have also contributed to a charitable organization, you have made the donation to them, and in this situation 80G will come into picture. You can claim the deduction up to 50% of the amount which are donated, or entirely 100%, depending on in which organization you have paid the amount, you have donated the amount. Accordingly, you can claim the deduction up to 50% or up to 100%. Apart from that, if you have any kind of saving bank interest income, then up to 10,000 rupees it will be allowed as exemption under section 80TTA. So these are all the major chapter 6A deduction which you can avail by investing into it and maximize your tax saving to a great extent. While investing into something, there are some common mistakes which every layman makes. So how we can avoid it, we'll be seeing all of that one by one. First one is that actually we don't understand the investment. So best way to avoid this is to build a diversified portfolio of the exchange traded funds or the mutual funds. If you do invest in individual stocks, then make sure you thoroughly understand each company's stocks that represents. So before you invest, first of all you'll have to make a thorough study about the investment, and then only you should invest if you are making the investment individually. Then another mistake which we do is falling in love with that company. So too often when we see that we have invested in do well, it's easy to fall in love with that, right? And forget that we bought the stock as an investment. Always remember, you bought the stock to make money. If any of the fundamentals that promoted you to buy into the company change, consider selling that stock. Then if you have heard that slow and steady wins the race. So slow and steady approach to portfolio growth will yield you greater returns in the long run. Expecting a portfolio to do something for you other than what it is designed to do is a recipe for disaster. So this means if you need to keep your expectations realistic with regard to the timeline for portfolio growth and returns. If you have lack of patience, then this will be causing you a trouble. Then too much investment turnover will also create a problem. So turnover or jumping in or out of the positions is another return killer. Unless you are institutional investors with benefit of low commission rates, the transaction cost can eat you alive. Not to mention the short-term tax rates or the opportunity cost of missing out on the long-term gains of the other sensible investments. So perhaps the number one killer of investment rule is emotion. The that fear and greed rule the market is true. Investor should not let fear and greed control their decisions. Instead, they should focus on the bigger picture. Stock market returns may deviate widely over the short time frame, but over the long term, historical returns for large cap stock can average 10%. Over a long term horizon, portfolio returns should not deviate much from those average. In fact, patient investors may benefit from the irrational decisions of the other investors made. So these are the small things which you can keep into your mind before investing, and after that only you should be investing. Now I'll be showing you the demo of filing the ITR. Just give me a second so that I can switch my screen. I hope my screen is visible to you. Yeah. So coming on to this, how you yourself can file your ITR using the Cleartax platform. First of all, go on to cleartax.in site and you will see this kind of a page. By going on to this, upload your form 16 page will come. So click on this, upload your form 16 over here and click on proceed. If you don't have your form 16, then you can click on continue without form 16 and proceed with your the next further steps. I'm assuming that whenever everybody would be having your form 16 with you, then you can upload it and this will be in front of your screen once you upload your form 16. Awesome, we read your form 16 successfully. If you are working with multiple companies or if you have worked and if you have another form 16 also, then you can upload it, yes I've changed job, and if no, then you can click on no, let's proceed to e-filing. After that, you will see the summary table like total income which I have received from your salary, gross total income, and everything. Then you'll see personal information tab. All your personal information will be captured from your form 16. Your first name, your last name, date of birth, your PAN number, and everything will be mentioned over here. Then in the address tab, your address will be shown and that will also be taken from your form 16. Then in this registration tab, your PAN number will be mentioned over here. Then it will ask you for the Aadhaar OTP. The OTP will be shared on your phone number. Once you will enter the OTP, then this will be processing your request. Once your OTP is received on your mobile phone, you'll have to enter it and then submit OTP. Once this is done, your PAN will be successfully registered and you can proceed to pre-fill or you can continue without pre-fill also. That will be up to you. Now you are eligible to make the direct filing from the platform. Then if you want to, if you have clicked on this proceed to pre-fill, then you will see this kind of page. we have automatically pre-filled your tax return. So your personal information details will be mentioned over here, and even your salary details and every income details will be automatically captured since you have selected the pre-filled option. When you will go to the second tab, which is income sources, so under your salary income, the name of the employer, all your salary details will be shown over here, and all the income details, amount, everything will be mentioned already. If you want to change anything, you can do it. If not, then you can proceed to the next tab. In next tab, you will see other income heads. Other income includes if you are having any kind of interest income from your bank, from your saving bank, or from your deposit, FD deposits, and everything. If you have any kind of dividend income, all those income you can enter it in the other income head. Then third one will be the house property head. So in house property C point, if you'll see that if you have any kind of self-occupied house property, if you have taken a loan, enter the interest portion over there and enter your new property address, and you can proceed to the next income. In the tab, you will see the capital gain head. If you have sold any kind of capital gain asset, say for example any kind of stocks, mutual funds, or anything, then in this situation you'll have to enter those gain income over under this capital gain. Then you'll have to click here if you have sold any asset. Once you will click on this, you'll have to upload your capital gain report. When you click on this upload file, you will see you'll have to choose the report provider. Our software supports the Cleartax template, then CAMS, Carvey statement, Upstocks, ICICI, Direct, Grow. If you have any of these PDF or the file with you, which you have been received from your broker, then you can upload it directly. Software will automatically will read your file, and they'll calculate your either short term capital gain or long term capital gain as per the whatever details are mentioned in your report. Software will automatically generate your gain or loss income. If you don't have any of these reports, then you can just download the Cleartax Excel template, enter all your income detail, all your transaction details in that Excel template, and you can directly upload that Cleartax Excel template. Then it will be preparing your capital gain report. They'll be parsing your Excel file, and then it will show you that awesome, your data is successfully imported, and it will show you the summary of the capital gain of the file which we have parsed in the software. So this is how capital gain thing will work. Then in the deduction tab, whatever chapter 60 deductions, 80 deductions you are having, you will be entering one by one over here. And if it is mentioned, it will be mentioned in your form 16, then it will be automatically captured by the software. So ATC, ATTTA, all those you'll have to enter. Then in the taxes paid column, you'll have to upload your form 26As by clicking on this. You can download your form 26As directly from the income tax portal and upload it over here. Once you have done that, and if you are having any kind of taxes due, then in the self tax payment you'll have to add the entry over here by first making the tax payment on the government side, and you'll have to enter the challan number and BSR code in the self tax payment. Then in tax filing tab, which is the last tab, first you'll have to enter your bank information, your Aadhaar card detail, and your bank account number, IFSC, and name of your bank. Then in e-filing tab, you will see the summary table. If you are getting any kind of refund, then it will show you awesome, we have refund amount. And if you have any kind of taxes due, so it will redirect you to the income tax portal. First you'll have to make the payment through your bank account and enter that challan detail in the self tax payment. After that, for filing the return, if you are satisfied with all the details, and also Cleartax will recommend you that which regime will be beneficial for you, which you should continue with by providing the summary and comparison table. If you want to see the comparison, then you can click on this compare and switch. And if you want to switch to new regime, instead of the recommendation, then you can also do that thing. There will be no problem. Once you have done every step, you have checked everything, then you can just click on this proceed to e-filing. When you click on proceed to e-filing, you will be seeing your detail once again, your name, your father's name, and your place. Just tick box this I have read and I agree to the terms and conditions, and click on e-file my ITR. Then it will ask you to pay the amount. Just pay, you'll have to just pay rupees 99 at e-file, and it will be, and if you want to buy any kind of tax expert plan, you can do that. CAs will be assigned to you for your case. They'll be doing all your work, and they will be giving you the computation sheet for your verification. Once you say yes to them, then only they'll proceed to e-file. When you will buy the plan and everything, your e-filing will be successful. It will be, your tax return will be submitted directly to the income tax department, and it will also give you your acknowledgement number. After that, you'll have to just e-verify your return, and that's it. Your work will be done very successfully, and also you'll be getting the acknowledgement number and the confirmation message over WhatsApp also from Cleartax. And in your mail ID also, you'll get the confirmation and your acknowledgement number. This is how you can file your taxes yourself, and everything will be done very smoothly. So now I'm happy to take up all the questions. Most of the questions would have been answered by Namita. If you have any further questions, you can ask. Are there any further questions? Yes, 80 CCD2 section is over and above the limit of 1,50,000. No, Ishan, there is no limit. Naveen, there are many long-term gain tax benefits and everything, but you cannot avoid any kind of tax. If you have sold any kind of stocks, then only you'll have to show it under capital gain head and file your ITR too. If you are an existing NPA subscriber, then you can also subscribe to this APY if you meet the basic eligible criteria under this scheme. I think maximum questions we have answered. If you have any further queries, you can write to us at support@cleartax.in. This is our mail ID, and we are happy to answer all your questions over there. Our support team is there to help you out. There is one more question. Yes, if you are claiming 80DDB section, then you will have to submit the certificate to your employer if you want to include it in your Form 16. Thank you so much everyone for joining. I hope this was a useful session for you. Have a great evening ahead. Thank you.